The fortune disappeared. How did this happen? It began like a fairy tale. The Mirror Group grew fast. Newspapers bought papers. Factories and presses hummed. A founder rose and centralized control. Revenues looked healthy on paper. Pensions and long debt quietly swelled off the page. Early balance sheets showed odd related party loans and large dividends. Those were the first forensic breadcrumbs. The choice came next. Management picked growth and cash extraction over pension security. They pushed acquisitions. They paid insiders. They drew dividends. Money moved from company coffers to linked entities. Capital that should have bolstered the pension pot was redirected. The pension fund quietly thinned. The risk multiplied. For a while, the promise held. Newsrooms ran headlines. Employees kept steady paychecks. Families planned retirements. The founders' sons were hailed as heirs. Readers never saw the hidden cracks. The public face was prosperity. Behind the scenes, the company needed more cash. That need led to a secret decision: a flotation. They launched what insiders now call the ghost flotation. The company raised $250 million from public investors. The pitch was strong. The accounts on offer were anything but. At the time of the float, core accounts were hollow. The flotation pumped fresh cash into a structure already bankrupt in all but name. New risk, new money, same holes. The momentum became a highway. New deals, new payouts, new related party loans. A pattern took shape. Cash flowed out through paper companies. Dividends cascaded to insiders. Debt accumulated in special purpose vehicles kept off the main books. The public saw growth. Creditors saw promises. The pension fund saw erosion. The company's books looked clean to most eyes. The reality was different. Warnings showed up. Auditors flagged qualifications. Credit covenants were breached. Whistleblowers wrote memos. Cash flow statements didn't reconcile. Forensic accountants later pointed to inconsistent reconciliations and off-balance financing. The signals were there. They were ignored. Each ignored warning raised the cost of failure. What happens when the founder vanishes? He was found dead at sea. Control collapsed. Governance disappeared overnight. Regulators and police stepped in. Forensic teams began to map money movements. They found loans to opaque cousins of the group. They found dividend cascades into private trusts. They found trusts and shell companies in 3 jurisdictions. They found a ghost network where debt of $2 billion hit off the books. Investigators found that $460 million was missing from employee pensions. The discovery detonated markets. Credit lines were cut. The company unraveled. A decision followed: criminal trials. Authorities pursued the founders' heirs. The trial became the most expensive fraud prosecution in history. Evidence rooms filled with spreadsheets. Forensic reconstructions filled the screens. The public watched every hearing. New risk, the legal system's limits. The cost of litigation ballooned. The state spent millions to find answers. Then the outcome that shocked everyone. The sons walked free. Acquittals followed after a trial that cost the public tens of millions. Assets were tangled and moved. Witness accounts conflicted. Burden of proof in criminal law proved high. Many victims left without closure. The most shocking result was not only the missing money. It was that those who inherited power escaped conviction, while pensions and public trust remained in tatters. The human toll was immediate and deep. Retirees found letters telling them their pensions would be cut. A nurse with 35 years' service lost half her expected income. A pressman had to sell his home. Small towns that relied on the group's payroll watched shops close. Families who planned retirement now worked part-time. Anger grew. Men and women who had built the business felt betrayed. The son's acquittal added salt to the wound. Relief for defendants felt like injustice to the victims. Forensic economists rebuilt the path of money step by step. They traced related party loans that looked like normal contracts. They mapped paper companies that bought assets, then leased them back. They showed how dividends flowed through 4 layers of entities before landing in private trusts. They reconstructed cash flow maps and zoomed in on ledgers where entries did not match bank records. They pointed to 3 clear mechanisms that enabled the theft: off-balance sheet vehicles, opaque related party transactions, and aggressive dividend policies timed with pension underfunding. Numbers stuck to the bones of the case. $460 million gone from pensions. $250 million raised in a flotation when the core accounts were effectively empty. $2 billion in debt hidden outside the balance sheet. Tens of millions spent on the prosecution. Hundreds of lives upended. Those figures explain the scale. They do not explain the suffering. At the midpoint, act now. Demand full, independent audits of company-sponsored pension schemes. Push for plain language disclosures. Insist on tougher rules for related party transactions. This is not just history. It can happen again. After the trial, asset recovery was piecemeal. Some properties were seized. Some cash was clawed back from junior partners. Much remained contested in civil courts. Pensioners received partial compensation years later. The forensic audit files laid bare how the corporate and accounting machinery hid debt. Special purpose vehicles recorded liabilities that were contractually linked to the group, but legally separate. Intercompany loans carried terms that masked economic reality. Auditors relied on management representations without digging into party links. The gaps in oversight became clear. The legal and policy responses followed. Parliament tightened pension protection rules. Auditing standards were strengthened. Related party disclosures became stricter. Regulators gained more power to widen investigations. But new loopholes were found quickly. Offshore jurisdictions still shelter complex webs. New financial products can replicate old tricks. New risk arises with each innovation. The personal stories remain. A daughter who planned to pay for her child's education saw plans collapse. A union rep says he warned managers for years. A whistleblower lives abroad, still fearful. A forensic accountant sits in a small office and points to a ledger entry and says, "Here it went." These voices keep the story human. They keep the outrage alive. We will show animated cash flow maps. We will zoom ledger lines until ink becomes a highway of missing pounds. We will sit with retirees in their kitchens. We will listen to defense counsel explain why innocence is not the same as morality. We will place experts next to the people who lost everything. We will close each chapter with a cliffhanger. Who signed the checks? Who gave the final okay? Who benefited while pensions were drained? The final lesson is stark. The machinery that allowed a dynasty to fail is technical and legal and human. Paper companies, related party contracts, aggressive dividends timed against underfunded pensions, weak audits, complacent boards. The combination is lethal. The control failures were not a single error. They were a repeated set of choices that added up. Could this happen again? Yes, if oversight relaxes. Yes, if transparency is rhetorical rather than tangible. Yes, if the public does not demand plain books. The central forensic question remains. Where did the billions go in exact sequence and to whose benefit? Follow the cash and you find the answer. At the end, act again. Watch the full reconstruction. Share the stories of those who lost. Support reforms that keep pensions safe. The missing $460 million is still a line on a ledger that refuses to close. The hidden $2 billion is a shadow over corporate accounts. The ghost flotation that raised $250 million from the public while accounts were empty is a warning nailed to the mast. We will follow each pound. We will name the mechanisms. We will show how the cover-up happened. And we will keep asking the same question until the answer is public and final. Who engineered the theft? How did the machinery hide it? And how do we make sure it never happens again?